French stocks rally as Barnier makes budget concessions. Welcome to Market Insight. I'm Ramzan Karamali. Well, early in the day, the CAC 40 was down as much as 1.2%. It's now in positive territory for the day, and the euro also gained some stability after France's government said it had scrapped plans to change 2025 medication reimbursements in what investors took as a concession to avoid collapse. But does that mean France's financial problems have disappeared? Well, to help answer that and more, I'm joined by James Smith, Developed Markets Economist at ING. James, thanks so much for joining us. So can investors feel a bit calmer now, or is there still trouble ahead?
Well, I think investors like the fact that something has moved, right? We've been in this deadlock situation, but clearly the fundamentals of the situation haven't changed. I mean, there were concessions last week, of course, and that didn't seem to satisfy Barnier's opponents in Parliament. So let's see, we've still got these bills that are supposedly coming through Parliament this week, still a big chance of a no confidence vote. And I suppose the fundamentals are this: there's no stable majority in Parliament to get sort of one option through or the other, and election can't happen for some time. So it's still a very tricky situation, but I suppose the sign of movement is being taken positively.
So, James, how could all this political uncertainty and uncertainty surrounding the budget impact the rest of Europe?
Well, I think it's an awkward moment for all of this to be happening, of course, because Europe is kind of looking at itself strategically with the re-election of Donald Trump. In many ways, this is a time to kind of get investing and try and support the economy strategically over the next few years in the face of stronger protectionism. Clearly, the French budgetary situation doesn't help that. So I think really the spotlight with all of that is going to be on Germany over the next few months. Of course, they've got their own election coming up early on in the new year. Will the infamous debt brake get tweaked? Will that open the door to more investment in Germany? It's only really Germany that can, I think, materially move the needle in terms of that sort of bigger picture investment story.
Now, James, ECB policymakers meet next week. Do you think any of this will impact on whether they cut by 25 or 50 basis points?
I think the focus of the ECB is very much on the day-to-day data flow right now. How quickly is the Eurozone economy really slowing? We had purchasing managers indices a couple of weeks ago that were pretty bad. So the doves are really sort of pushing for a 50 basis point cut this month. But the hawks are saying, well, maybe these aren't sort of reliable signals. I think the more interesting debate is what happens after December, regardless of whether we get a 25 or a 50 basis point cut this month. I think it's much more about how low the ECB's policy rate goes. Isabel Schnabel, one of the arch hawks at the ECB, was talking about the inflationary risks of a Donald Trump presidency. We're a little bit skeptical about that. With sort of our own view at ING is that we're going to get below 2% on the deposit rate next year. But that feels like where the real battle is right now.
Now, the ECB's chief economist, Philip Lane's been speaking to the FT, and he said the future decisions should be based on upcoming risk rather than economic data. Why do you think he would say that? Is this something to do with the next US president, do you think?
I think that's definitely the implication of those words. It's quite interesting, actually. The ECB, I think, is getting more vocal about the discussion about what Trump presidency means. Sharp contrast to the Federal Reserve, actually, where they don't want to talk about it at all, I suppose, not unsurprisingly. As I say, there's a big range of views from the hawks and doves in terms of what it means. As I say, Schnabel was talking about the upside risks to inflation. I think you'd really say if Trump's policy, if he's raising tariffs, that's going to be negative for Eurozone growth. That's what financial markets are assuming. I think that is going to mean sort of lower inflation, weaker growth. That probably means more accelerated rate cuts next year.
Now, you mentioned inflation there. It did tick up in November, but overall, do you think it is heading back to 2%?
I think there's a chance of a bit of a pickup in the near term in headline inflation. But the thing that really stood out to me was services inflation. It's really been stuck around the 4% area for the last year or so. The reason we single all that out is it's the bit of the inflation basket that supposedly central banks have more control over. And, that has slightly ticked lower. I think that's the thing we're really watching next year. But as I say, the inflation side doesn't seem to matter as much right now for the ECB. It's all about growth.
James Smith from ING, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.